previous sessions that we've done where people wanted to know a little bit more about the tax side of things. So we've responded to that request. And tonight we're going to, for you to find out what you can and can't claim against your rental income. Also, we've got a session on sort of the mortgages and how to gear your investments as well. And also, how, if you're looking to expand your portfolios, what's the best way of actually securing your next property that you may want to find. What I'd like to say is that we have, in the packs that we've given you this evening, there are the slides there, so you haven't found them already, and there's some space on the side to write any notes. And what we're going to be doing at the end, there will be a question and answer session, so if you can refrain from perhaps answering questions along the way, just make a note, and then we'll take the questions at the end. What I will say, some people sometimes aren't particularly happy at doing the whole open forum of questions. So we will have a time period of about 10 to 15 minutes with the questions. However, if you would like to ask somebody on an individual one-to-one basis, we're more than happy at the end, because there's plenty of staff around that can actually answer any questions with regards to tax, rentals, sales, etc., mortgages. So we're quite happy to do that, and we will be on hand at the end. So we've also, as a thank you for everybody coming along tonight, there is the lottery ticket in your pack as well, so for tomorrow night, so hopefully somebody will win. And you can always give me a little bit as well. So, and also just to let you know, we are filming this tonight, and it is actually going out live on a live link, so we are taking some questions on the live link as well, so we may have some questions coming across from the guys up to my left, right here, so that's just in case you wonder where did that question pop out from. So, sorry, for those people who don't know anything about Andrews, we've been around since 1946, and we actually started off as a furniture shop, so this was the original photo that they managed to find, we are one of the country's leading property specialists, and we actually have over 58 branches dotted around the southwest and southeast of England, and that's estate agency and lettings, and also covering mortgages as well. So as you can see, we've got quite an extensive branch network. We also have an asset management side of the business that manages properties all around the country as well. So we've also got some experience with regards to around that sort of side around the country. So if you've got properties that are not just in those localities, then we can also give you some advice there. We're also very pleased to announce that we're an award-winning service, and we've won several awards across the group within Andrews, and I'm very, very pleased to say that from the industry recognising, you know, the service that we give to customers and things, and the way that we do it. And last year we were actually awarded on the letting side as a specialist letting agent the Bronze Award for the Best Large Letting Agency of the Year, and that's competing against some of the big likes countrywide Connells Group, so quite impressive from our point of view. And that's down to the trained specialist staff that have got the experience, that are giving you the best advice as a landlord as well. Obviously, why does tax matter? And what we've done tonight is partner with Karen Press from Bishop Fleming, and she's going to be on hand to give you lots of advice as a tax planning expert, actually specialising in property tax planning as well, and also general income tax side of tax planning for customers and clients. So she's going to be able to give you lots of advice and hopefully go away with some hints and tips that you didn't know about tonight. The reason, but why does it matter? Well, one of the things that there was a report that came out that more and more, obviously, the Inland Revenue, or HMRC as they're now known, are always on the lookout for people that don't declare their rental income. And there's believed to be, according to them, around 900,000 landlords that don't declare income sometimes, fully declare. And obviously, if you don't declare income, then you could be faced with very strict penalties. Also, if you declare very late, penalties there, and that's going to ultimately hit on your rental yields. And I can say that more and more the HMRC are actually looking out for those people that aren't doing it, because they need to reclaim money across the board. So I'm going to pass you over now to Karen, and she's from a company called Bishop Fleming. And at the end, all of us, you will be actually also hearing from our mortgage gentleman and also our sales side. And like I say, at the end, we will be able to all answer questions for you. Okay, Karen.
Thanks, Debbie. Hi there, my name is Karen Press. I'm a tax manager at Bishop Fleming. I've been doing tax for 19 years, specialising in individuals tax planning, and especially property the last couple of years. I'm going to cover quite a bit tonight, so like I said, if there are questions, please leave them at the end. I do appreciate there's quite a lot to take in. I've got quite a few slides. Just to cover the introduction to tax, really, just to give you a bit of an idea of what you should be doing, and also a few planning tips that hopefully you're doing already. If you're not, obviously you can put them in place. Bishop Fleming, we're a full service firm of accountants, so we do everything from individuals' tax returns, sole trade accounts, limited company accounts, audits. We do a lot of tax planning. We're now 7 offices. We've got an office in Bath and Bristol. Bath is the latest addition about 2.5 years ago. Quite a few partners, and we've got quite a lot of tax experts in our firm. What I'm going to cover tonight quickly, an introduction to tax compliance, just a reminder really for what you need to be doing. Cover off the allowable rental expenses just to make sure everybody's claiming what they can. Quick overview of tax rates for income tax and capital gains tax when you come to sell your rental property, and lastly some tax planning ideas. Here is a nice slide. Unfortunately for all of you landlords, rental income is taxable. Most people do this by doing a self-assessment tax return each year. First year that you need to, when you rent a property, you need to notify the revenue by the 5th of October following the end of the tax year which you started. So if I bought a rental property tomorrow, I would need to register for self-assessment by the 5th of October 2015. It's got quite a long time to do it. You do need to get your registration with HMRC. Most returns are filed online, and if you do that, your deadline is the 31st of January following the end of the tax year. For those of you that had rental properties, you should be looking to do your tax returns for the 5th of April 2014, quite soon. If that's online, you've got until the 31st of January 2015. If you're still doing a paper tax return, you've got until the end of next month. Tax payment is due on the 31st of January. So again, those of you doing your tax returns for 2014, looking to pay a tax bill at the end of January 2015. I've just put a note here about losses. When you first buy a property or if you're a rental void, you may have a rental loss. And that's mistaken that you don't need to disclose that, but it's always better to disclose your losses to the revenue. Even if it's the first year that you bought your property, make a note of it, disclose your income and your expenses to the revenue, and get your loss on your tax return. That loss is available to carry forward against future rental profits. It's not lost, you can just carry it forward, and that can reduce your future tax liability on rental profits. Here's the worst slide, so we're going to even go quite early in the presentation. Penalties. This is one of the revenues, things that they like to stress quite a bit on the telly. We'll get the adverts coming around shortly. Like I say, if you're doing your tax return to the 5th of April 2014, it needs to be in by the end of January 2015. If I file my tax return on the 1st of February, I will get an instant £100 penalty. I could have rental losses, I could have no tax to pay at all, I will still get a £100 penalty, and there's no getting out of that. The penalties ramp up the longer your tax return is outstanding. 3 months, £10 per day, maximum of £900. Look at a £1,000 penalty quite quickly. That is purely here to remind you that you need to get your tax returns in on time. The second part of the slide is a reminder of the tax penalties if you pay your tax late. Like I said, the tax is due the 31st of January 2015. That's paid early March, you're looking at a 5% surcharge. As the time goes on, penalties increase. Let's not forget that the revenue charge is 3% on all taxes paid late, so it can be quite expensive. Again, just stressing to get the tax returns done, submitted on time, and tax paid. Another note on record keeping. All of you landlords here, you need to keep your records for 6 years. New tax return now to the 5th of April 2014. You need to keep those records until the 31st of January 2020. What I normally recommend clients to do is have a file. So have your bank statements, have your rental statements, managers, have your mortgage statement, have all your expenses, your gas safety certificate, your insurance documents, have it all together in a file. Complete your tax return using that information. print a copy of your tax return and have it all to hand. If for any reason you're selected for an inquiry, you've got everything together. As a revenue, we want to see where you got your figures from and the evidence of where you got your figures from. So it's easy to keep it all together for any future reference. Just a point there about the inquiry. If the revenue raise an inquiry into you and decide that you've been careless on your tax return, such as not adding up the rent correctly, they can give you a tax-based penalty of up to 30%. So, tax return on time, double check it, make sure it's accurate, file it, pay your tax, keep it all together. Won't go far wrong. Residential property campaign, as Debbie mentioned, this has been ongoing as the revenue. They believe that there's 900,000 landlords that aren't declaring their rental income to them. They want to find them. The campaign here is effectively to encourage landlords to come forward. That's what the revenue want. Anyone who's got rental income that hasn't disclosed it, contact them, speak to them, disclose it, move on. They're very quick to note that their campaign is the best possible terms, as with anything with HMRC. If you approach them and say, oops, haven't done this, didn't realise, they are far more favourable on you with penalties. If they find you, that's when the penalties will ramp up. Just a two-part process. If you know anybody that hasn't disclosed income, rental properties, just need to notify the revenue. That can be done online quite easily. There's a phone line. They will send you a disclosure number, and on that disclosure number you can then disclose to them what you haven't declared to them previously. Quite interestingly, on their website you can self-assess your own tax, you can calculate your own interest and the penalty and pay it across to them, all online. I would say if anyone's in that position, speak to me, speak to any decent tax advisor just to make sure you're disclosing everything correctly. And I've just got a note here to expect the revenue to use information to target. They've got access to quite a lot of records, mainly land registry. They can easily see who owns what property and probably can bring up if you more than 2 or 3. Again, if anyone's in that position, speak to me after. I've got the nicer watch of the HMRC notes on that for you if anyone wants to look at them. But yeah, just notify if you need to. Just a quick note here on the renewals basis. This only affects landlords that rent their property unfurnished. With effect from the 6th of April 2013, you can no longer claim a deduction if you need to replace your cooker, fridge, freezer, carpets, curtains. You still need to replace them, you're going to need to replace them for your tenants, but you can no longer claim a deduction for them. You pay out, no tax relief. The only exception to that, as I've noted here, is where you've got integrated white goods. So if your kitchen in your rental property has got an integrated dishwasher and it breaks down beyond repair, you can replace that in full and claim the deduction. If it's a freestanding unit, no, it's now gone. So just a note there, if you're renting properties unfurnished, that applies to you. Ooh, here we go. Allowable expenditure. I just thought I'd put this up just to make sure that everyone's fully aware of what they can claim. We're all aware of the rents that we're receiving in. We just need to make sure that we're claiming all of the expenses. The lower your profit, the less tax you need to pay. As you can see, I've got a cross there on property enhancements. That is allowable deduction, but that will be allowable when you come to sell the property. So if you buy a 92-bedroom property and you enhance it, this day and age, really, that's only extensions. Put a nice extension on the back and then rent it. The cost of putting the extension on the back will only be taken into account on the sale of that property in the future. And that will reduce the capital gain, which effectively is the profit you've made by owning that property. So that is allowable, just not on an annual basis like everything else is. I'll just go around the loop very quickly. Agent and management fees. If you pay an agent to find you a tenant, management fees, fully deductible, including the VAT that you pay. Mortgage interest is allowable, and please note interest only. If you have a repayment mortgage on your rental property, you cannot get a deduction for the repayment element of that loan, only the interest. Repairs and maintenance, leaky tap, leaky roof, dodgy door lock, all of that, you're allowed to deduct that against your rental income in the year that you incur that. I've put mileage on there, and this is something that sometimes is forgotten. every time you visit your rental property, you can calculate the mileage and claim a deduction. Depending where your property is, how many times you need to visit, again, leaky tap, go and let in somebody for a viewing, that type of thing. Keep a log, calendar, phone, just note on how many times you visit that property and calculate the mileage, because you can claim that deduction at 45 pence per mile. Not loads, but if you've got a few properties that aren't on your doorstep, you're travelling quite a bit in and out to go and meet people, meet agents, everything, it all adds up. And like I say, every pound you can claim a deduction, it just reduces your tax liability. Legal and professional fees, if you employ an accountant to do your tax return, that's an allowable deduction against your rental income. And wear and tear allowance, this only applies to landlords that rent their property furnished. And this is to cover your having to change your furniture in due course, renew your beds, your sofas, table and the chairs, wardrobes, that type of thing. It only applies to furnished properties. It's an annual claim, which is equal to 10% of your gross rents. So if you get an £800 a month for your rental property and it's furnished, £80 a month of the deduction for wear and tear. Obviously, if I go and buy a rental property tomorrow and do a quick run down to IKEA to kit it out, my initial upfront cost is not allowable, but I will get 10% of my gross rents on an annual basis, and that's just to cover me replacing when tenants break the bed or something like that. So again, that as the rental incomes are going up, and if you have got furnished properties, that can be quite a high expense for you to claim each year. I'm going to touch on the spoke a bit of a typo on the slide, on to the next slide. Just a reminder of the tax bands for you. Everybody has a personal allowance in the current year of £10,000. Asterisk, unless your income's of £100,000, in which case it starts to tick down a little bit. Everyone's got a £10,000 personal allowance. If your income aside from that is just under £32,000, you'll pay income tax of 20%. If it's above that but below 150, you'll pay 40% on that amount. If you're lucky enough to go over 150,000, you'll pay tax of 45%. A little note here about capital gains tax, as I mentioned before. When you come to sell a property, there's tax to pay, and that's capital gains tax. That's calculated slightly differently. You get an annual exemption each year. The current tax year, that's £11,000. So once your gain, your property is under £11,000, there won't be any capital gains tax to pay. If it's above that, there will be tax. And depending on your income will depend upon whether you pay capital gains tax at 18% or 28%, or in some cases a little bit of both. Let's say that I've got a capital gain after my annual exemption of £20,000. If my income aside from that is only say 10, my total income, including the capital gains tax, is 30,000. So I will pay capital gains tax on my gain at 18%. If my income is say £40,000, then my £20,000 gain would be taxable at 28%. And if my income is around, let's say 25, I'll pay a little bit of capital gains at 18, and the majority at 28. That's just how that interacts with your other income. Tax planning, this is what the slide we're looking forward to. Just a few bubbles there on what we actually look to do for property. There's quite a few things that we can cover and discuss with clients to try and make their property tax efficient. I'm just going to cover a few of those this evening for you. Okay, loan interest planning. Okay, we talked to landlords quite a little bit about loan interest planning, and it's quite difficult to explain just in words to quite a few people, but I'll have a good go. And as you can see, I mentioned before that on a rental property, the mortgage interest is an allowable deduction against your rental income, therefore reduces your profit subject to tax. And what we look to try and do is people that have got, in this, like this case scenario here, rental property with a mortgage and a main home, again with a mortgage, we try and make sure that overall we claim as much loan interest as we can against a rental income. So if we look at the example on the board here, we've got someone with a rental property they bought for 250,000, with a mortgage of 100,000, interest say 3%, probably told them that later on, might be a little bit high, and obviously then you claim that within your accounts. Aside Aside from that, this individual has got a main home with a £150,000 mortgage, again interest at 3%. Obviously they never be claiming the loan interest on that mortgage on their main home. As we can see by the example here, what we want to do is overall there are borrowings of £250,000 and the rental property was bought for £250,000. And the whole point of the loan interest planning that we look to do is effectively to move that mortgage on the main home into an environment whereby we can claim the loan interest. And we can do that, I say quite simply, there's a few steps we need to do. Just a few things up here really. The reason that we can look to do that is that income from a property is treated as a business. And if a loan is taken within a business to repay its borrowings, then the interest charged on that loan is an allowable deduction. So as we can see from the example previously, the rental property was bought for £250,000 with a mortgage of £100,000. That day one, the individual effectively gave their rental business £150,000. In reality, that may have been from savings or from borrowing more on their main home, but ultimately they've introduced £150,000 into that business. And what we can look to do is you can look to change your borrowing on your main home, not increase it, but just get a new loan and declare that that new loan is purposely to repay the capital from your business. You don't increase the borrowing, you don't need to increase anything at all. It's just basically by having a new loan in place, it means that you can make a declaration to confirm what the purpose of that loan was. And once that's in place, the interest on your new loan on your main home, £150,000, is an allowable deduction against your rental income. Just put a note here about the restrictions. Numbers in my example are quite neatly put together, being £250,000. Basically, the restriction you have is the initial purchase cost is the maximum amount of loan interest that you can claim. So this is before we had an example of the purchase price is £250,000. That will be the maximum amount of loan interest that we can claim. As I said, the £100,000 already on the buy-to-let, the £150,000 on the main home. If the mortgage on the main home was say another £50,000, £75,000 on top, we'd still be restricted. The maximum amount of loan interest we could claim would be £250,000. That's purely by restructuring. As you can see now by the revised example, rental property, purchase price £250,000. The mortgage of £250,000 is now fully allowable against a rental property. The loan interest that we're paying, assume the same rate, is still exactly the same as before. The only difference is we're getting tax relief for it. So whereas previously we were restricted to the £100,000 loan interest, we're now allowing the full amount of loan interest paid between the two mortgages. The only thing I would point on this one is just two things. Obviously Mark might come to himself in this moment, is you just need to consider the mortgage you've got on your main home. I'm here saying it's perfect, remortgage, restructure, everything else. You need to take that into account what your current mortgage is. If you've got a very low tracker, maybe 0.5 above base, or you've got a hefty redemption period, you've got another 2.5 years time, or we've got to pay a £5,000 fee to get out, it might not be the right time. So it's considering everything as well as the taxes. It may not be good from a tax point of view, but from your mortgage point of view, it may not be the best thing. Like I say, because of rates, redemption fees, but it's always something just to consider and have at the back of your mind. Equalise income as well. As we talked about the tax rates earlier on, people pay tax at 20%, 40%, depending on their income, might not pay income tax at all. If you own a property with your spouse or civil partner, and you own it jointly, you're probably putting half of the income on each tax return. You can actually transfer property between spouses without any tax issues. So if one of you is, say, 20% taxpayer and the other one's a 40% taxpayer, it makes sense to have more of the share of the property in the taxpayer's name who pays tax of 20%. For example, you may have maybe I'll tax of 40%. You may decide that between you, actually, I'll have 80% as the lower taxpayer, and the higher taxpayer will just keep 20%. And providing you do a declaration to effectively both agree that that's the proportion you're going to own the property in going forwards, and do a form to HMRC declaring that, showing them the declaration confirming that going forward it'll be assessed 80%, 20%, you can do that. That's a very good tip, especially if you've got people with different rates of tax. I'm just going to cover off EPR relief, for private residence relief. This is where if you lived in a property and then rented a property and then sell a property, you can look to get some capital gains tax relief. As we all know, if you've got a main home and we live in it, we do renting it, we sell it, there's no capital gains tax. Same applies here. If you've lived in a property and then you've rented it, there's some reliefs available for you. The exemption is got quite a strange calculation. The actual period of occupation is exempt for capital gains tax purposes, as now is the last 18 months of ownership. Used to be 36 months, but the government took a little bit of that away. So, for example, if I owned a property for 6 years, I lived in it for the first 18 months. The last 18 months I'm deemed to have lived in it as well. Therefore, my PPR relief is half, because 3 years out of 6 I'm deemed to have lived in it. So immediately my capital gain is going to be put in half. It's going to reduce my potential capital gains exposure. In addition to that, we've also got lettings relief. So in the previous example, my capital gain was say £40,000. We discussed half of that gain would be exempt, so I'd be left with a capital gain of £20,000. In addition to that, I can claim some lettings relief. I can let a property that previously was my main residence. There's a bit of different calculation for that one. As you can see, it's a lower value of. We said that my PPR relief was £20,000. So overnight, my gains reduced to zero. There was no capital gains tax on the sale of that property for myself. This may be applicable for people that maybe wanted to move a couple of years ago and the market wasn't great, so rather than sell their main home, decided to rent it and buy the home that they wanted. This would apply to you. And just one last point on capital gains tax planning. Like I mentioned before, every individual has an annual exemption. The current tax is £11,000. So the first £11,000 of any gain that I make is not subject to capital gains tax. I mentioned before about having properties owned jointly between spouses or civil partners. This is another thing. If potentially you own a property in your own name and you have a spouse or civil partner and you're looking to sell that property, you may well have a large capital gain. If you transfer part of that property into your spouse's name, therefore own the property 50-50, providing that spouse hasn't sold any assets in the tax year or are planning on selling any assets in the tax year that would give rise to capital gain, you can make use of their annual exemption. Like I said, it's for everybody, the £11,000. Say for argument's sake, I have a capital gain myself of £20,000 on the property that's in my sole name. Prior to the sale, I can transfer half of that property to my spouse. We could then sell the property. We would have a £10,000 capital gain each, and we wouldn't have to pay any capital gains tax. Numbers-wise on that one, if you're a higher rate taxpayer, i.e. you would pay capital gains tax of 28%, by doing this piece of planning, you save yourself over £3,000. And ultimately, with property, whether it be income tax or capital gains tax, you're going to receive the rental income. You may well sell the property and get a capital gain. But if we can reduce down the income tax and the capital gains tax, the exposure between the household to reduce it down, all the better. I think you've got my business card in your packs. Any queries? Like David said, I will be available afterwards for any particular questions. I do appreciate I've gone through quite a few things at quite a rapid pace tonight, so do feel free to contact me or catch me afterwards. I'm going to hand you over to Mark. Thank you,
Carol. Good evening, ladies and gentlemen. I have the pleasure of talking through gearing tonight for you. In essence, this is really the industry's name for spreading your investment. And the example we've got, we're going to look at, is somebody who's potentially got, say, 200,000 and they're looking to buy a property. Would it be better for them to buy a property and use all that money and have rental income, and as we've already heard, taxable? Or could they spread their investment and actually increase their portfolio? Would that be better from a profitable point of view and a tax point of view? Within the packs you've got in front of you, you should find a handout. There are some maths that we're going to go through. I apologise. But it is relatively simple, and the figures we've taken do make it flow quite easily. So, one property financed with cash, purchase price 200,000, and we're basing it on a rental of £1,000 per month. Quite a nice investment. The alternative would be to take the 200,000 cash and to utilise that by putting down a 25% deposit on 4 properties. Why 25%? Because the majority of the mortgage industry will have products and rates available to you up to 75% of the value of the property. In doing so, we then have 4 properties, potentially at 200,000, giving you a total investment of 800,000, a deposit of 50,000 per property, and a mortgage of 150,000 on each of those properties. What that does, though, is increases your rental income fourfold from the 12,000 you were expecting on the one property now to potentially 48,000. However, the mortgage payments are also increased fourfold. But the difference between the two is your £200,000 will give you a net income of somewhere in the region of 21,000 for the 4 properties, as opposed to 5,250. In addition, you've got capital growth. If properties increase in value over a period of time, say by 10%, and you use your cash to buy one property, we have an increase of 20,000. If you've got 4 properties, that's 20,000 on each property. So again, simple maths tells you your 200,000 is now gained you 80,000 over a period of time. Advantages, therefore, well, we've mentioned 2: increase in capital by more than just what your cash can do, and also the rental income on a month-by-month basis. Plus, by having the 4 mortgages, you have got a greater allowance for deductible from a tax point of view. Yes, there are some disadvantages. More property, which means you will have to manage your time, and you're going to have more queries unless you have the properties managed for you. You've got less equity in each property. The mortgage market rewards customers with lower interest rates with the greater amount of equity in the property, with the better rate clicking in with a 40% deposit. It's down to somebody like myself to work out what is the best way. Do we spread your investment over 2 properties, 3 properties, or is it the 4 properties? Taking into account what you want to gain from that 200,000 in the first place. And then last but not least, you've got tax implications, higher rental income and capital gains, which we've already potentially heard about. Here at Andrews, we deal with the whole of the market. We have no restrictions on where we place business. It's down to an individual's situation and circumstances, and together working out what is best for them. With the buy-to-let market, it's not all about the lowest interest rate. As the majority of deals do come along with some quite significant fees. They do range in the marketplace more often than not from around about 0.5% of the borrowing, going up to 3.5%. So we need to take fees into account as well. Property needs to be in a lettable condition, and lenders will decide how much they are going to lend you based on the rental value of the property, and that's often worked out by a given percentage of 5%, with the rental then being 125% of the mortgage payment. I've already mentioned the high arrangement fees. Independent, whole market, buy-to-let, exclusive rates, take time and money. Just to give you a bit of a story as well, I've got one client at the moment who I saw last week. Buy-to-let, he's got 9 in a portfolio with 9 mortgages, coming towards the end of retirement. We have a tax expert online, and we're reducing his portfolio, mortgage portfolio, down from 9 to 6. remortgaging 6 of those properties and actually increasing his income by over £500 a month. And that will tell you how good rates are at this moment in time. Pass you over to Stuart. Thank you.
Good evening. I just wanted to have a little session really with regard to purchasing property, because the market at the moment, I'm sure you all know, is pretty fast and furious. Not only are you, if you are in a position to proceed and you have the funds available, that doesn't necessarily put you in the pole position to get a property if you see the right one. And obviously, just hearing what Marcus just happened to say about gearing, it might be that some of you are thinking about expanding your portfolio. So I just wanted to share with you a few tips this evening on how you, as buyers, can maximise on your strength as a buyer against, let's be honest with you, a number of competitors at the moment out there, all trying to do the same thing. Now, in your packs, first of all, you will notice that there is a whole selection of properties we've put together for you from across our network of sort of 9 Bristol branches of potential investment properties we've looked at. That's just to give you a little bit of a taste of what's out there at the moment. We've given you an idea of the sort of rent that can be achieved in there as well. So do have a chance to look through those. But moving on to the actual purchasing of property at the moment. You may well be experienced on buying property. It may well be that you've just recently bought one. But if you haven't, you do enter into the market at the moment as a buyer. Gone are the days where you start an estate agent yourself, got nothing to sell. I can release property, release money from the property that I own already, and I'm ready to go. Unfortunately, competition is rife out there, and you need to be one step ahead of that. We like to class it as, we like to be market ready. That's something you'll read quite a lot about on our websites and so on and so forth. Market ready will technically put you ahead of your competition as buyers, but what it will mean is you'll have to do a little bit more work before you go out and stick a property on, stick an offer in on a property. Before you even get to the point where you're offering, we as agents and our potential clients, our sellers, will pick the buyer who is in the strongest position and who can proceed probably the quickest. It's not necessarily about the offer amount that you put forward. So, as an example, in order to be buyer ready, we would expect you, if you were looking to release equity in your current property to give you a deposit, we'd have expected you to have done that before you put the offer forward. That will give you a little tick in proceedability stakes. We would also like you to have your mortgage agreed and ready. So literally a phone call to the advisor and you're off. I'm sure Mark would be delighted to help you on that side of things. We also would like you to have instructed a solicitor, but they could well have done some of the background checks that the solicitor needs to do before you proceed with giving them an address. If you get those 3 things sorted out prior to you putting an offer forward, hopefully that'll mean that you won't miss out on that fantastic investment that you spotted. Because if you spotted it, maybe there's probably 10, 15, 20 other people who have spotted it as well. The other thing I wanted to talk as well about is a new side of Andrew's that's going to be coming up, which is going to be very much primed towards the audience we have in here today, and that's about the investment club. We are going to be opening up an investment club within Andrew's. It's going to be coming relatively soon. That will be basically letting you know of all the investment properties that come to the market we think that you will be interested in. Okay, now that is around the corner, it is coming. So I would urge you to get onto Andrew's online and register your details there. And we will inform you then of any investment property that comes to market, not just from us, also from our sister company, which will be across nationwide as well. Okay, so there's just a few tips for you as a buyer right now. That just gives you a little bit of a behind the scenes what us as agents are talking to our clients about when we're recommending people to go with various offers that are on the table. It's not only about the money that's put down. Okay. I now come to an end, and I think now we're going to enter into the questions section. So I've got all the experts on hand here. So if you would like to raise your hand if you have a question, and who you have a question for, then that person will ask the question for you. Gentleman at the front here.
I'd like a little bit more information on rental losses. For instance, can you set aside a loss if you have a gap in tenancy because one's left before you can recruit another one?
What, in the tax year?
In the tax year, we have a 6-week gap, for example, this year. can I offset any of those losses of rental at that time against tax?
Yeah, because what you'll do when you come to do your tax return to April 15, you will add up all of the rental income received over the year and have to do all of the expenses. So you will get relief for it if you won't have rent for those 6 weeks. So your rental income will be lower than the previous year, but your expenses will be the same level. And if that does result in a loss overall, then that can then be carried forward to next year. And if you make a profit next year, the loss reduces the profits tax.
Oh, so you have to have an overall loss, basically.
Yeah, because if you've got one property or 10 properties, each tax year you add up the total rental income, the total expenses to come to the overall profit. So if you've got one that you're making a loss for whatever reason, and two that are making a profit, it's the average overall position that's subject to income tax year.
Okay, next question. Yes.
If I go in a mistake on my tax return, happily I've not claimed sufficient expenses against it. Can I lob those expenses into the following tax year without making a big issue about it? Am I allowed to sort of transfer them from 1 year to another?
So what you need to do is amend your tax return. So your tax return to 5th of April 13,
Yep.
if you filed it online, you can go in and alter that without any issue at all and reduce.
No, I did it on paper and I've already got the calculation back telling me
Oh,
the
right, it's
tax that I've
5th of
due.
April 2014.
Yeah.
Yeah, that's fine. If you haven't claimed the relevant expenses, you can just wipe them, print off some more land and property pages off the internet, complete them as it should be if you've missed
No,
the
but I
right
can't
expense.
simply do it by putting those expenses in
No.
the current tax year. That
No,
would be
just needs to
wrong.
do a quick letter. If you're doing a paper return, just write to them and they should amend that and then update your calculation form. If it's years prior to that, you can amend it right again by letter.
Gentleman back.
Sorry, Karen, what's the example of figures?
Sorry, maybe this were.
For example, of lettings relief, some figures.
Yeah. Thank you. Perfect. Let's say that we have an overall gain of, say, £80,000. As I mentioned before, maybe the same example, half of the period is exempt from PPR. So I've reduced that gain down by £40,000 to bring it down to an overall gain of £40,000. Again, lettings relief is the lower of three figures, either £40,000, the amount of PPR relief available, or an amount to bring your figure down to zero. So in the case here, again, using the same example, gain 80,000, half the exempt because of PPR, because I've lived there, brings me down to £40,000 gain. As I said, the lettings relief again is the lower figure of PPR relief for 40,000. So again, using these figures, it would bring my gain down to zero. It's not always 100%, but if you've got a property that you've owned for 5-6 years, you lived in, it's been your main home, and then you've rented it, you're not going to have a huge sizable capital gain generally. If you've owned it for 20 years, and obviously only lived in it for say 2, there will be a higher proportion of gain, and therefore you will have, a chargeable gain that's taxable. If you've got a specific one, like you can catch me after we've got some rough figures, we can just have a quick look and see what the position would be.
Any other questions?
Second row.
Yeah, how do you find furnished from the point of view of the 10% wear and tear allowance? Like, for example, if your tenant says, I'd like to bring my own bed or my own sofa, like you bring most things in and not everything. Does the place have to be fully furnished?
You can get away with part finish. I'd say it probably would fall on your tenancy agreement or anything else.
I think if you've got some furniture in there, I
Yeah.
think it would be classed as
That's
furnished.
what I thought. They bring a couple
partially,
of
and
things,
I
for
think-
example,
yeah.
you need one sofa, move there, another one in there, they say, want to bring their bed, but you have to have your wardrobe test and so on. That's still classed as fully furnished.
For the exemption, it would be that furnished or unfurnished. They don't do like a part furnished, so
Yeah.
it would fall in.
I did want one or the other, didn't know whether there's a minimum sort of
Yeah.
amount of stuff,
when you become a landlord, as long as someone can sleep there, can occupy the property, so bed, wardrobe, sofa.
Yeah.
But like I say, if you supply it furnished and if they actually bring away the mattress, you remove that. That's
Oh
not
yeah,
gonna,
that's
you know,
fine.
deter. But like I said, keeping the record, your tenancy would be another good thing to keep as well if you are renting it furnished. If you've got your contract, like Andrew, to say furnished property, you know, that's the agreement with your tenant is furnished, wear and tear allowance, off you go.
If you have a portfolio of 10 properties, can you just have one furnished and the rest not furnished?
Yeah, each property can be how you finish it or don't finish it. That may depend on the market you're trying to attract in a certain area. You know, you might have certain properties that if you say they're furnished, you will get tenants. So it's tax reliefs that are available, but ultimately the overall goal is to keep the property limited as much as possible without any gaps. And that may be that for some areas it's not suitable to have furnished at all. Other areas it may well want furniture and then you can get anywhere in there.
Yes, madam. So very much.
Talk about land declarations. How do you do this on the website? You can go and declare.
Generally, a declaration, you know, most tax advisors compare declaration for you, or possibly a solicitor. It's just a declaration essentially you might be transferring, if you're in a property 50-50, you might be transferring 30% to your spouse to make it more advantageous for income tax purposes. Would you
Do you
both
have to
sign
send
that?
that in?
If you're going to do it for income purposes, then yes. When you disclose to HMRC that you're now going to own it 80%, 20%, say, you send in the declaration together with Form 17, which is where both of you agree from the date of the declaration, one's entitled to 80%, one's entitled to 20%. If you don't send all of that in, the revenue will expect at all times rental property that's owned jointly to be 50-50 on the tax return. So sometimes people, if they miss that, they can share the ownership. Yeah. If you've done a legal transfer, the solicitor is owned completely in your spouse's name now, completely you've got the mortgage, the land registry, everything, and obviously that's categorically their property and everything. It's only when you've got two names on there, spouses, that it's unless otherwise stated by yourselves, it's always tested.
It's probably a strange question. There's capital gains tax. You said if you buy a house to rent it out, it's treated as a business. Can you get entrepreneurs relief if you sell that then?
No, you'd hope so, wouldn't you? But no, if you buy a property and you rent it and you come to sell it, you calculate capital gain. Often talk about KPI and letting fees, that is only available if you have physically lived the property and it is in your main home. Aside from that, it's a simple calculation of your net sale proceeds, take off your net costs, and then work out your capital gain, and then you'll be assessed on that. Obviously, if you're any exemptions available, you can use that and you'll be taxed 18 or 20%.
Did you have a question? Just
Can you add children to it?
If they are over 18. If you're going to buy it and you've got minor children, if you do try and put it in their names, if you could do legally, there could be an issue with mortgage and everything else. But any income that in your children's name where you have given them the money, so in this case you might be able to transfer a house to them, it's assessable on you for income tax purposes anyway. But as they reach 18, you could look at transferring some of the ownership of the property. Would be a capital disposal for you, but like I said, if you've got a spouse and you're in the property jointly, you can transfer a small portion each to make use of your annual exemptions, and then the children are over 18 and then pay tax on their share of the income that's received in their name. And it is because you transfer a quarter, say, to your child, you'd be assessed a quarter of the net income.
okay, we're just going to take one more question here, and I think then we've got some questions online as well. So, the gentleman in the middle.
What's the position if you own property and you live in it, part rented? Okay.
If you rent a room, is that what you're talking about? Yes, someone's rented, that's absolutely fine. Providing more than the limit, which I think are currently £4,250 per annum. If you rent out a room or rooms and you receive less than that, there's no income tax to pay, no obligation for you to pay anything costs of revenue. And again, because you've rented a room in your house, it's still your property, it's still your ownership of your house. Therefore, when you come to sell it, it's like anyone else who's on your main home, there'll be no capital gains tax to pay either. That's a very good way of earning money, rental income, without paying tax.
But the limit is
4,250.
Right.
Yeah. If your income's above that, for whatever reason, you put it on your tax returns, so say you receive £5,000 for argument's sake in total rent, you just be taxed on the difference of £750 on your tax return.
But your capital gain must be taxed.
Okay, do we have some questions?
Yes, we do. We've got a question from Margaret Keeping, who says, could you say something about the environmental payments? What is included for tax relief?
Do you have to email me separately?
Okay. Another question is from Judith Pemberton Bennett, who says, if I sell one property to buy another one or two, am I still liable for capital gains on the sale?
Fortunately, yes. If you sell a property, it is subject to capital gains, regardless of whether you want to use that to then buy 2 or 3 properties. It's still assessed as an independent capital gain, and capital gains tax is payable.
Okay, thank you. We've got Just Me, whose question is, if carpets are not allowed, what about tiles or wood floors?
No, it's all gone now. If you rent an unfinished property, any renewals of that kind is no longer tax deductible.
Okay, I think you've addressed this one, but I'll bring it up for Tom Allison, who says, what if it's partly furnished? I have a property where I own the sofas, some furniture, white goods, but not the beds. Can I claim 10% wear and tear allowance?
Providing that his rental agreement says he's renting a furnished property, then yes, it's not uncommon for tenants to want to bring their own beds or mattresses. He's still making it available as a furnished property. They just won't have to remove one item, and that's fine.
Super.
One more? You got any more? Should we do one more?
I've got a few more.
Okay.
We can possibly address the other ones. Spencer Edgar says, can I offset the 10% for wear and tear on a monthly basis to accrue against replacement of furniture, etc., on a furnished rental?
I mean, that's effectively what you do. The wear and tear is 10% gross rent, regardless of whether you spend a penny or have to get it out for £1,500. It's just a tax relief when you come to do your annual income tax adjustment.
I've got 4 more questions. Do you want to deal with them now, or do you want?
Well, I was going to say, are there any more questions from the floor here? Yeah.
Unfortunately not, but all expenses, rule of thumb is all expenses on property will be tax reliable one way or another. Stamp duty on purchase, surveyor's fees on purchase, legal fees on purchase, all actually reduce down your overall capital gain. That gets taken into account when you sell the property. Similarly, when you sell it and you have agents' fees and you have legal fees, that effectively reduces down the money you're receiving on the sale of the items. That comes into play when you sell it in year dot. So just keep a note of it. I always say to clients, if you buy a rental property or anything, always keep a copy of the completion statement. If you pay a surveyor separately, which you may well do, just keep all of that together, because when you come to sell it, it's again reducing it down to reduce your tax.
Any other questions at all from in here? Okay. We'll all be milling around for a little bit, so if you have any further questions you wanted to talk to on a sort of a one-to-one basis, then by all means do. There is refreshments around, I understand, still, so by all means grab yourself a cup of tea or coffee or a soft drink, and as I say, we'll be around. I hope you've enjoyed this evening and you found it useful. Thank you very much for your time.
Do you want to address these before I sign off?
Yes.
Still live. Minors.
Yeah, that's going to be Find that probably not.
Yeah, because they're live.
I'll try and get people out. How many questions are there? What filming?
4 questions, still filming, still live. For anybody left online, I think you can see we've got a bit of a queue here, so what we'll do is come back to you in the comments with the answers to your questions. We'll make sure we come back to you. Thank you very much for joining us, and we're going to sign off now. Thank you very much.